All right, we're recording. This is Market Glitch, a channel about the market's technical analysis, algorithmic trading. This is Dion Kurzek, and with me is Volker Knapp. Hi, Volker.
Hi, Dion.
How's your trading been going?
Today I think it wasn't a good day, but not bad. Pretty quiet these days.
You're overweighted in Apple, I know that.
Yeah, right now I am. That's
And
quite sure.
I happen to have 0 apples, so pretty good day for me so far, but of course that can change, as we all know. For our first video on this channel, it would be interesting to explore one of the technical indicators that we all know and love, a very, very standard indicator, the RSI.
Okay.
Relative Strength Index, RSI. What's your feeling about the RSI indicator?
I think, it is quite good. It's valid. It has some indication. Just using it alone might be a little bit too volatile, but I think a lot of people look for it, so there is a self-fulfilling prophecy in it, probably.
Interesting. Okay. Well, we're going to use WealthLab Pro as a kind of testing platform to test out our ideas here. I developed a WealthLab Pro strategy over the past few days to help us analyze the RSI. For anybody who wants this code, I guess I can post this on the WealthLab forum for people to download. That should work, right?
Yep.
So, first thing first, how is RSI calculated? What is it? I mean, we've all seen the indicator, and I can actually go to our indicators here and drag and drop the RSI onto the chart. So here we have the RSI, this line here. But what is it? How is it calculated? Any idea, Volker?
No, actually, I never looked into it.
I mean that's typical with these indicators. We all use them and we see how they respond, but we don't know how it's derived. So we're going to get into that now very quickly. Let's kind of deconstruct the RSI. Let's go into our editor and see what I've done here. So I've created a couple of new data series. What I want to do is capture the daily gains and losses, because RSI is calculated based on gains and losses. So what I'm doing here is going through each bar in the chart, and I'm calculating a variable called gain. So gain is equal to the closing price minus the previous closing price. So if that gain value is greater than 0, I assign that to a data series called gains. If it's less than 0, I assign it to a data series called losses. Makes sense, right?
Yep.
And then I plot those two gains and losses so we can go to our chart and we see these lines. The red lines are losses and the green lines are gains. And as I click through the different symbols, we see our gains and losses updating. And I'm going to remove this RSI right now because we'll get back to that later. Let's focus now on how the RSI is created. Okay, so we've got our gains and losses. The next step is we take the average gains and losses. And whenever we need to get an average, we can use the SMA indicator, simple moving average. So here I am getting the simple moving average of the gains and the losses over 20 bars or 20 trading days, and then plotting that as a maroon and a navy line. Let's run that and see our little difference here. And sure enough, we now have a couple of other lines here. We have the maroon and the navy blue line. So this is our average gains and losses over a 20 bar period. Because when you use RSI, you have to specify a period, right? You have to say, I want the RSI 20 or the RSI 10 or whatever you want. So we're going to go with 20 just for this example. So the next step is we're going to calculate kind of the basis of the RSI, how the original RSI creator computed the RSI. So first we get this RS, it's the average gains divided by the average losses. And then we use this formula, 100 minus 100 divided by 1 plus RS. So if I now run this again, we'll get something up here that looks kind of like the RSI, right?
Yep, looks like it.
I mean, it's moving in the same range. We know RSI is considered oversold when it goes below 30 and overbought when it goes above 70. So it's looking similar, but what I'll do now is I'll plot regular RSI on that same pane. So here's the red. The red is the standard RSI indicator. The yellow is our indicator that we just created. So, it's moving roughly in the same, kind of direction, but there are differences.
Interesting.
I'll bet if we go to the beginning of the chart, that at the very beginning, I'll bet that they'll be the same. Let's see. Okay, see here? This
Yep.
Kind of the first bar where both of them actually had a value, and sure enough, like right at the beginning, they're both the same, but then they start diverging. So the reason is, and if we can go to one of my favorite websites, Stock Charts, which gives great information. I don't know, Volker, if you've ever been on stockcharts.com.
You have been there, yep.
Yeah, this is a great site to learn about different indicators, different technical trading concepts. So this talks about how the RSI is built. It was created in 1978 by Wells Wilder in his book, New Concepts in Technical Trading Systems. So here's the important part. The first calculation is a simple 14-period moving average of the gains and the losses, just like I did. So here's the difference. The second and subsequent calculation is based on the prior value and then the current gain and loss. So when he was doing this in 1978, he was calculating this by hand. So every day he would need to update his RSI, So instead of, recalculating the whole thing like he does in the first period, he just takes the previous value, multiplies it by 13, and then adds the current gain or current loss, and then divides that by 14. So if it would be a 20-period RSI, you would take the previous gain, multiply it by 19, add the current gain, and then divide it by 20. So it was an easier way to manually compute the RSI.
So basically it means we're using a wrong RSI because he was too lazy to do the calculation, or he didn't have a computer to do the calculation.
Right, and that the side effect of that is with us to this day. So this yellow RSI might actually be, worth kind of testing, and maybe we could do that in a future video and see, is it more valuable than this standard RSI here. But now we know how the RSI is calculated. I want to see, can we quantify, what kind of edge that it gives us, or what kind of value it gives us actually. So my idea was, I want to compare the returns of buying the market when the RSI is oversold, so when it's below 30,
Mm-hmm.
to the average return of just the overall market.
Mm-hmm.
What I did in my code is I created a script here, which will give us the RSI's edge. And I'll run this first and then explain what it's doing. So I'll run it first on one symbol, Apple, for example. So go to our debug window. Nothing there. I think I actually have to run it on the whole list. So let me run it on the whole NASDAQ 100. Now let's do our debug window again. Okay, so here we go. And now, as I go through here, yeah, now I can see I got some stuff printed here on the chart. So the first line, average returns.
Mm-hmm.
What I did was, for every bar in the chart, I calculated the percentage return after 5 trading days. So since we're using an RSI with a 20 period, I figured, let's see how well it is at predicting, the profit or return after 5 trading days.
Mm-hmm.
So in this Adobe, for example, if I buy here, then after 1, 2, 3, 4, 5, my return might be 0.2, 0.3%. So what I've done is I've taken all of the 5-day returns in the history of this chart and averaged them together. So for Adobe, the average 5-day return is 0.49%.
Mm-hmm.
So however, the next line is showing you what the average 5-day return would have been if you would have only taken those days where the RSI was below 30, below its oversold level.
Mm-hmm.
So in that case, the average RSI return was 0.87. So it does give you an edge, at least in this stock, of 1.78, which is pretty good. And as we kind of click through the other stocks, 1.28, negative 0.77. So that one, it didn't help on this stock.
Mm-hmm.
1.04, 2.66. And if I go back here again and run it on the whole universe, all of the 100 stocks in the NASDAQ 100, and I go to my debug window, make that stay on top, I'm listing all of the stocks and what the edge of the RSI is for each one. Then on the bottom, I'm giving a little summary. So 82 out of the 100 stocks did have an RSI edge. And then on the bottom, I have a global RSI edge. So this is taking all of the returns in the entire universe of the NASDAQ 100 and dividing it by the returns of only taking the returns when the RSI is below 30. So the global RSI edge is 3.23. So I think that's pretty significant.
I think this is a very significant number. And as I said, it might be that RSI has some valid points or a self-fulfilling prophecy. So it definitely shows that you should rather buy if the RSI is low than if the RSI is high. I think.
Yeah, we could easily test that if I go to my editor here and I make a small change to the script. So let's say, here's my filter. So we're saying if the RSI is less than 30, then we're going to take those.
Mm-hmm.
So let's change it and say greater than 70. So now we're only going to include data where the RSI is over greater than 70. So let's compile it. Let's run it again on the NASDAQ 100, see what we get. All right, look at that. Now the global RSI edge is 0.30, so there's no edge. So basically, if it would be a 1, it would give you kind of the same value as the overall return, but it's much worse. It's 0.3. And
Yep.
I hadn't even done that before, so before you mentioned it was the first time I tried that, so that's pretty interesting.
Yeah, absolutely. I mean, it shows the value of the RSI, or at least it gives you a timing, or it gives you an advantage if you know you rather buy it if the RSI is low.
Right. I mean, I think it's just a way to quantify the old saying, buy low, sell high.
Yep, yep, absolutely.
And let's go back and get it back the way it should be there. And kind of the last thing I wanted to do is run this on a few different universes just to see. We see on the NASDAQ 100, the edge was how much? Let's see.
3 point something.
3.23 on the Dow 30 stocks. I should have updated my data beforehand, but look at that.
Wow.
On the Dow
Wow.
30, the edge of the RSI is 6.36.
Wow.
So let's try it
Wow.
on the ETFs.
That'll be interesting.
Yeah, ETFs don't have survivorship bias.
Wow. This is even more.
On the ETFs, the RSI edge is 7.85. So I think we established that the RSI, even though it's such an old classic indicator, does provide some value in technical trading.
Yeah, I mean, this is a no-brainer. And as you said, the ETFs don't have survivorship in it, because I wanted to say, well, we only look at the good stocks now, but with the ETFs, there is no survivorship. ETFs are ETFs. Of course, it depends on what kind of ETFs you have in there, but I assume they are probably mostly indices and maybe some bonds or something.
Oh, here.
Yeah, I wouldn't know. Yeah, I wouldn't know what all those symbols mean, but I mean, except some of them.
Emerging markets,
Yeah,
biotech, Dow, the diamonds, industrials, Australia, Canada, Germany. Just
yeah. So wow, it's cool. I mean, and they have the highest edge from all using the RSI.
Yep.
It's amazing.
Some good information, and we can feel good about using one of our favorite classic indicators.
Yep. So it's pretty good. Pretty good stuff. Very good.
So if you like this video, subscribe and give us a like. And like I said, if you want the code for this, I'll be posting it on the wealth-lab.com forums. Sound good, Volker?
Sounds excellent. I love it, like it, and it shows the power of Wealth Lab. Pretty good, very good. Yeah, hope people like it and join into a discussion.
All right. Yep. Take care, everyone.
Yep. Bye.
Bye.